Good morning, everyone. Thank you, Alex. First of all, I would like to tell you I'm very glad to be here, and I'm sorry because I don't speak Spanish, so my presentation will be in English, as you can hear. And basically, to be honest, the key messages of this presentation are quite similar to the one of Alex. So don't be surprised if you find some slides are similar. We haven't talked to each other before the event, I swear. But anyway, the key messages of my presentation is that, to be a little bit simplistic, the risk outlook is improving in key advanced economies. And on the other hand, it's deteriorating a little bit in emerging markets. Not in all emerging markets, but in some large emerging markets. I will say more about this in a few minutes. So there are plenty of reasons why, the risk outlook is improving in large advanced economies, and on the other side, it has started to deteriorate in some key emerging markets. There are plenty of reasons, as I said, but if there is one, of course, you're well aware of, it's oil prices. Basically, oil prices, lower oil prices, it's a good news for of course, oil importers. And on the other side, it's a negative news for oil exporters. And if you look at the overall picture, most advanced economies are mostly oil importers, and most oil exporters are coming from the emerging world. So basically, this is maybe the first factor why the risk outlook, there are diverging trends between, on the one side, advanced economies at the moment and emerging ones. And the point is, lower oil prices are going to. It's a new structural trend. For us, we can't expect a strong rebound in a short period of time of oil prices. And the reason is most factors that have been pushed oil prices lower are structural. Whether you look at the demand side or at the supply side, all explanatory factors of lower oil prices for us are more long-term ones. On the demand side, I will say more about this later, but the lower GDP growth in China is something structural. It's a long-term trend. And on the supply side, as you can see here on the right part of the slide, there is an excess of supply on the oil market. Mainly because if you look at the oil exports at the global level, there have been a surge in exports coming from the US, as you know, and on the other side, it hasn't been offset by a lower supply coming from traditional exporters. So all in all, there is at the moment a kind of an excess of supply on the market, and we can expect this is going to last. Because even if you expect that next year countries like Iran are going back into the market, we can expect, of course, that this excess of supply is going to last. So all in all, you have to be used to lower oil prices at the global level, and of course, this is having a positive impact on some countries, mainly most advanced economies. Of course, there are exceptions, like there are also large emerging markets like China, like India, that are benefiting from lower oil prices. But for most emerging markets, this is something which is negative. So basically, how it works. How does lower oil prices impact GDP growth in advanced economies? The first channel is, of course, inflation. We have been talking a lot about deflation risks in the Eurozone and in Europe over the past quarters, but the point is, when you look at inflation dynamics in advanced economies, you can see it here on the left. Inflation has been slowing down in a large number of advanced economies, not only the Eurozone. Inflation is now very low in the US, it's very low in the UK, even in Japan is quite low. So basically, it means that this is something positive in terms of purchasing power for consumers. And maybe the best example is the country where I come from, France. When you look at the overall situation there, there are not so many good news. Unemployment is very high. The savings rate of households is very high as well. And despite this, consumer confidence is up, and consumer and household spending is increasing. The only reason why it's increasing is because of lower inflation, which is boosting the purchasing power of households. So lower inflation is helping. It's helping in advanced economies, as I said, but it's also helping in some large emerging markets. You see on the right part of the slide inflation dynamics in some emerging markets. So as you can see, inflation is surging in some of them, like Brazil, Russia. There are, I would say, exceptions, and I will say more about this in a few minutes. But in a lot of other ones, like China, like Korea, I could have added some Central Eastern Europe countries. Inflation is going down as well, and of course it's a positive news in terms of growth, at least in the short term. And the second channel explaining why lower inflation means higher growth in the short term, it's because Alex, of course, talked about it, but it's because of loose monetary policies. If you go back 1 year ago, I mean, almost everybody expected the US Federal Reserve would have high rates by the end of 2014. The same in the UK. Nobody would have expected that in the Eurozone, the ECB would have loosened one more time its monetary policy. The same in Japan. And 1 year later, I mean, monetary policies all around the world, even in China, in Korea, in Asia, are much looser, much more expensive than expected. And so because of lower oil prices and low inflation, we have also to get used to very loose monetary policies for a long period of time. And the best example, once again, is coming from the US. I mean, it's the same story this year. At the beginning of the year, I mean, most analysts were expecting the Fed would have hiked rates, I mean, in March, then in June. Now it's going to be September or December, and nobody knows exactly when, at the end, the US Federal Reserve will hike rates. So in terms of global growth, you see this is a key reason why we expect global growth to be a little bit higher this year. You can see it on the right part of the slide. Having said this, you see that okay, global growth is picking up a little bit, but we're still far away from the pre-crisis levels, and we're still far away from the pre-crisis levels, mainly because of course, advanced economies from one part, but mainly because of emerging markets. If you can see the breakdown and the contributions in the green bars. The green bars are contribution to global growth from emerging markets, China and other countries, other emerging markets, and the blue bars are the ones from most advanced economies. So first of all, you see that now growth is going to be a little bit higher this year compared to last year, but basically it's still much lower than the pre-crisis levels, mainly because of emerging markets excluding China. And the second point is that if you compare now, I mean, 2015 with 2012 and 2013, I mean, the breakdown between emerging markets and advanced economies is much more balanced. 2 years ago, I mean, around 75% of global growth was coming from emerging markets. If we're right in our forecast, this year it's going to be only 55%. So now you have to keep in mind that global growth is going to be much more balanced, and advanced economies will contribute a little bit more to it. If you look more into details at where does it come from, mainly the higher growth this year comes from basically the US. So I'm sure you have heard about maybe the negative figures in the first quarter in the US. From our standpoint, these are mostly temporary factors. I mean, there have been some bad weather conditions in the first quarter of the year. Of course, we also see some negative news impacting exporting companies in the US because of the stronger US dollar. But beyond this, for us, whether you look at the situation from the corporate side or from the household side, the situation is pretty good. I mean, from the household side, you see that unemployment is decreasing. Alex talked about it. We see that consumer spending are still expanding quite steadily. The recovery of the real estate sector is underway. And if you look at the situation now on the corporate side, I mean, corporate profit at still very high. Investment is still quite high as well. So I would say that in the medium term, we're still pretty confident growth is going to be quite dynamic, of course, in the US. The only one risk in the short term coming from the US is maybe related to what I've talked about a few minutes ago, is related to the US Federal Reserve monetary policy. When finally the Fed will decide to hike rates, some sectors could be impacted. Specifically, I mean, in such cases, basically, we can expect a moderating growth in sectors like the real estate. But we think in this case, in this specific case, the most impacted sector would be the automotive one in the US, as you can see on the right chart, mostly because over the past years, we have seen a very strong growth on the car sector in the US, but basically mostly because of very easy access conditions. At the moment, 85% of car purchases are made through credit. So basically, when the Fed will decide to hike rates, it will have an impact on the sector. But beyond this, once again, we're still pretty confident growth is going to be dynamic in the US. So as I said at the beginning, we're also more positive, of course, on the Eurozone at the moment. I mean, the point is there are plenty of, I would say, factors at the moment that are helping growth. Of course, one of them is oil prices. The other one is the lower level of the euro, of course. We can also say that, I mean, now fiscal policies are not dragging on growth anymore, at least in most countries of the region, not all, but in most of them. So all of this helps, and all of this explains why now businesses are more confident. You can see it here on the left. Having said this, we still see very different growth dynamics within the Eurozone. So don't expect growth to be much stronger in all countries of the Eurozone in the coming years. And I would say one of the reasons why growth paths will be very different from one country to another this year and next year is on the right part of the slide here. It's because of overcapacities. On the right chart here, you see we have looked at the level of overcapacities in some key countries. Okay, we have looked at the average, the historical average, and we have compared it to the last data. So basically, the score you see on the right part of the chart doesn't mean anything by itself. But what you have to keep in mind is that when the score is negative, it means that there are still plenty of overcapacities. Basically, it means that if tomorrow there is a higher demand in the country, I mean, companies have the means to match this higher demand without investing because they have a lot of existing capacities in the country. So you can't expect in these countries, basically France and Italy, a strong surge in investment in the short term, even though businesses are a little bit more confident, even though corporate margins are going up, because of these existing overcapacities. And I think this is a key differentiating factor at the moment within the Eurozone. Having said this, it's true that because of all positive factors I've mentioned, some countries are leading the way in the Eurozone of the recovery process. Basically, the first one is Spain. When you look at GDP growth figures, Spain over the past quarters has always surprised on the upside. When you look, basically, I mean, the recovery process in Spain is not really surprising. I mean, this is a basic recovery process we see in all economies after a deep downturn. I mean, first of all, the first step of the recovery is through exports. Then corporates that have higher export revenues invest a little bit more, and then they hire a little bit more people. It's like the old theorem the German chancellor in the 70s was saying: the investment of today is the production of tomorrow, and the employment of the day after. So this recovery process is very classical. It's basic. But what is surprising to me in the Spanish case is that the recovery process has been much faster than expected. Basically, we could have expected that the step one, maybe the recovery through export, would have lasted more than it has. We could have expected that the step two would have lasted even more. And at the end of the day, we're always surprised on the upside, and the recovery process in Spain has always looked over the past quarters faster, much faster than expected. So basically now, as Alex said, the GDP growth now is much more balanced, much more driven by internal demand and not only anymore by external demand. The only one key risk, of course, at the moment related to the Spanish economy is related to the political situation. The paradox is, it's not only the case in Spain, but social discontent, social frustrations come up when the recovery is here. And that's the paradox, and that's going to be the paradox not only in Spain, but I guess in a lot of other Eurozone countries in the coming quarters. Basically, when you have been unemployed and jobless for a long time, and you turn up your TV, and you hear about positive news in terms of growth, in terms of investment, but you don't see any effect on you, of course, it can create some frustration. And this is a key risk, I guess, ahead of the general election later this year. If consumers and businesses start being worried about what's going on after the election, of course, the recovery can be short-lived. This is not our baseline scenario. I mean, we of course we're confident, but this is a key risk I think we have to keep in mind. And Spain is a good example of what could happen in some other countries in the Eurozone where the recovery process has been delayed. It can be the same next year and ahead of the coming election in France in 2017. It can be the same in some other countries. So we have to be aware of this paradox. When the recovery comes up, basically social frustrations come up as well. And this is, I think, a key risk at the moment. We don't see such a risk in Germany, and after following Spain, this is the second country that is driving, I would say, the Eurozone, the Eurozone car at the moment. I think the key point on Germany is that the GDP growth breakdown is changing very fastly. And before the crisis, we used to say that in Germany, I mean, to be simplistic, Germany was profiting from the rest of the Eurozone by exporting to other Eurozone countries. It's not true anymore. Now, GDP growth in Germany is much more driven by private internal demand, and more specifically by household spending. Before the crisis, around 10% of GDP growth only came from household spending. Last year, it was 50%. This year, we expect it to be at 75%. So this is a new normal we have to get used to. And I think this is a good news for Germany because growth is going to be more balanced there. But this is also a good news for the rest of the Eurozone because other Eurozone countries, basically Spain, basically France, will export more to Germany in the years ahead. So you could argue, okay, household spending is going up in Germany, but such in other countries, it's a kind of a temporary trend because of lower inflation. That's true. That's partly true. But the point is, in Germany, working population is going to decrease in a short period of time from 2016 or 2017, even if we take very optimistic assumptions in terms of immigration, working population is going to slow. So it means that wage pressures are going to be strong in the medium to long term in Germany. So it poses risks in terms of long-term GDP growth, but at least in terms of household spending, this is a positive. This is something which is positive for Germany, and so for exports coming from other Eurozone countries. So basically, what we do at Coface is that the output we provide is country risk assessment. So the goal of this country risk assessment is to look at the average credit risk for corporate in a given country. So it's quite different from the ratings from the rating agency you hear about, because what they look at is mainly sovereign risk. What we look at is the average credit risk of corporates in a country. And to do so, we look at three kinds of things. The first one is a large range of macroeconomic and financial indicators like the one I've just talked about. The second one is our payment experience at Coface, because we're making businesses in about 100 countries in the world. So when our payment experience in a country is deteriorating, we can say that it reflects a worse economic outlook in the country. And the third pillar of our country risk assessment is our own business climate assessment, where we look at external indicators in terms of level of corruption, quality of infrastructures, and so on, and our own survey made internally at Coface, which aims at measuring business climate assessment as well. So The output is a seven-grade scale from A1 to D. A1 is the best risk, then comes A2, A3, A4, and then B, C, D, and D is the worst one. So basically on this table, there are plenty of letters and figures, but what you have to look at is the column in gray named March 2015. We update our country risk assessment on a quarterly basis. And basically on the gray column, you can see the last update. And basically what you see on this table is that when you look at the right part of the chart, you see a lot of blue. Blue means an upgrade, and at least you don't see any downgrade anymore, which are in red. So it reflects what I've just said. I mean, at best, the risk outlook is increasing, is improving in advanced economies, and at worst, it's not deteriorating anymore. And basically, you see we have upgraded countries like Spain, like the US, Germany. More recently, we have upgraded Belgium and the Netherlands. So it reflects exactly what I've just said. The recovery process is underway in almost all advanced economies, but the path of recovery is different from one country to another. Let me say now a few words on emerging markets. As I said at the beginning, we are now much more cautious when we look at emerging markets as a whole than we were a few years ago. And we are not pessimistic on all emerging markets, of course not, but we are of course more cautious on some large emerging markets, basically the one we used to name the BRIC. To be honest, this acronym doesn't mean anything anymore. And in the early 2000s, when people started to talk about BRIC countries, I mean, it was a way to summarize country where there is a large market and where GDP growth is dynamic. I mean, of course, in Russia, in China, in India, and in Brazil, there are still large markets, but growth is not dynamic anymore in all of these countries. You can see it on the left part of the chart. We even expect, I mean, such as Alex, of course, that growth is going to be negative in two of them this year, basically Russia and Brazil. There are the two, I would say, sick countries in the emerging world at the moment. So maybe let me start with Brazil, which is a very good example. In Brazil, we have seen over the past couple of years more and more problems, I mean, limiting corporate investment. Basically, these problems were related to weaknesses in terms of infrastructures. They were related to high inflation and high wage pressure, high labor costs. And we have seen over the past year a downward trend on private investment. So this is not new. But at least what we expected is that in the Brazilian case, on the demand side, even if there were some such of supply side constraints, on the demand side, we saw until last year that private consumption was still resilient, and it's not the case anymore, not at all, as you can see here on the right part of the chart. Even consumer spending, which is the usual growth driver in Brazil, is not working anymore. It's not working anymore because of, first of all, high inflation, which is hurting the purchasing power of households. It's not working anymore because of a kind of confidence shock related to all corruption scandals we have heard about over the past months. And it's not working anymore because of something we don't mention very often, is the household debt. Household debt is quite high in Brazil. Growth has been mainly driven by very easy access credit conditions over the past decade in Brazil, and the output is that now household debt is quite high. And basically, when you look at the household debt service, so the share of their monthly income households dedicate to repay their debt, it's now at 20%. 20%, it's much higher than in the US before the crisis. So think about it. I'm not saying there's going to be a huge and a deep crisis in Brazil in the short term, but at least I'm saying that this is a structural shock, and we can't expect a very strong rebound in growth in the short term in Brazil. And to some extent, what's going on in Brazil at the moment, it reflects, it's a good example of what's going on in the whole Latin America at the moment as well. I mean, of course, it's very simplistic to talk about Latin America as a whole. I mean, the situation is very different from if you look at Peru, for example, where the outlook is quite good, and on the other side, if you look at Venezuela, where it's the opposite. But if you look at Latin America as a whole, I mean, it has benefited from the commodity boom. Now it's over, and now it's over, we see all structural weaknesses that are coming up. And basically, these are weaknesses related to infrastructure, weaknesses related to poor productivity performances. So, such as in Brazil, you can't expect that growth is going to rebound very strongly anytime soon in the region as a whole. This is a structural shock, and we have to get used to this in the short and in the medium term, of course. As I said a few minutes ago, the second sick country at the moment in the emerging world is Russia, of course. I will be fast. Just in a nutshell, keep in mind that in Russia there have been, a triple shock. The first one, we often forget it, is a shock in terms of business environment, and it's not new. I mean, there have been massive increasing capital outflows since 2007 and 2008. So it hasn't started last year. The crisis and the problems in Russia haven't started last year with the political issues. And there were some such kind of capital outflows because basically both local and foreign investors don't trust the country anymore to invest there. So adding to this, there have been this political crisis, as you know, so this is the second shock. And the third one is the oil price shock, of course. The Russian economy is still very dependent on oil prices. And again, in this context, in this environment, what has been surprising last year is that we could have expected growth to be in negative territory last year. And it didn't happen. Growth was quite resilient, I mean, still positive at least. And the reason why it was positive, you can see it on the left chart here, is because of household spending. Basically, the government decided to hike pensions, to hike the level of civil servant wages, and it helped to boost private consumption, and it offsets the negative impact coming from the external shocks. The problem is it can't last. It can't last because even though the government has hiked pensions and civil servant wages in nominal terms, because of the ruble depreciation, now inflation is extremely high at 16%. So it means that in real terms, the purchasing power of households, and you can see it on the right, is now decreasing a lot. So all in all, the Russian economy was quite resilient last year, but you can't expect it to be resilient this year once again because of what I've just said. And that's why growth, there will be a deep recession this year, and that's why it's going to be a very difficult year for Russia. Once again, such as in Brazil, I mean, the outlook from next year will really depend on the political situation, but let's take the most positive scenario. Let's imagine that the political situation is improving in the coming days or weeks. Okay, the economic situation is going to improve a little bit, but once again, don't expect GDP growth to be back to the pre-crisis level. Even in Russia, this is a kind of a structural shock, and we have to get used to this new normal in this country as well. And the last country I would like to say a few words on is, of course, China. The situation is very different to what I've just said on Russia and Brazil. I mean, basically, we talk a lot about slowing growth in China because growth was above 10% a few years ago. Now it's closer to 7%. First of all, what you have to keep in mind is that it's a normal process. When your GDP per capita increases, your GDP growth has to slow. And this is what's happening at the moment in China. So this is not a sign of a crisis, or this is kind of a normal process. The problem at the moment in China, from our standpoint, is not on the macroeconomic side. It's more on the sector side. In some sectors, specifically sectors related to investment in infrastructures, like the steel sector, like the petrochemical sector, we see more and more weaknesses because there have been an overinvestment over the past decade. And the result is that now a lot of corporates in these sectors are over-indebted. So the problem for them is that they're over-indebted and they have to face to lower demand because there are overcapacities in such sectors. But on the other side, I mean, on the other side, there are still the households. All household demand related sectors are still quite resilient. And just to illustrate these overcapacities, you can see a producer inflation in China. It's very basic, but as you know it better than me, when inflation goes down, it means that when prices go down, it means that supply is higher than demand. And basically, it can happen in a short period of time in times of crisis. This is what you see here in 2001 and 2002. But the new normal, what is new in China, it has, you see on the right part of the chart, it has been down over the past 3 years now. So it means that it's not a temporary thing. It means that in some sectors, there are lasting and significant overcapacities in some sectors in China, and we have to be cautious on such sectors at the moment in this country. But once again, on the macroeconomic side, we are not more cautious than that. So basically, just to, and that will be my final word. On emerging markets, we also provide country risk assessments. And once again, it reflects what I've just said. We are more cautious on large emerging markets. We have downgraded Russia. We have put a negative outlook on Brazil. But on the other side, we are more optimistic on some other emerging markets, smaller ones. I've not time to talk about it here, but let's look at, for example, some Asian countries like Vietnam, like Cambodia, where we're a little bit more positive. We have also put a positive outlook on Tunisia recently. And so this reflects, and this is a key message of my presentation. The outlook now looks much better in advanced economies. And on the other side, we are more cautious on emerging markets as a whole, but more specifically on some large ones. Thank you.